Welcome to our comprehensive analysis from goldstandard.org. Real estate versus gold, which has been the better store of value? Today we're tackling one of the most debated questions in wealth preservation. Is real estate or gold the better store of value? What you're about to discover might challenge everything you thought you knew about these assets. For centuries, both have been considered premier stores of value. But when we strip away the effects of currency debasement and compare these assets directly, a surprising picture emerges. Let's start with a shocking statistic. While U.S. housing prices have risen 122.7% in dollars from 2002 to 2024, they've actually fallen 76.8% when measured in gold ounces during the same period. What's happening here? In dollars, U.S. housing prices show steady appreciation over the past 50 years, with the median home price rising from approximately $25,000 in 1971 to over $400,000 today. But this is largely a monetary illusion. When measured in gold ounces, which have maintained consistent purchasing power for thousands of years, a different story emerges. In 2002, the average U.S. home cost approximately 677.1 ounces of gold. By 2024, despite the nominal price increase in dollars, the same home costs only 157 gold ounces, representing a dramatic 77% decrease in real terms over just 2 decades. Real estate hasn't risen in value over time. Rather, the purchasing power of the dollar has fallen dramatically. Breaking down performance by economic cycles reveals clear patterns. During the 2002-2012 post-dot-com crash and global financial crisis period, housing collapsed 33% in USD terms. Gold surged 428% as a safe haven. Housing in gold terms fell 55%. Then, in the 2012-2022 quantitative easing era, housing recovered 89% in USD. Gold gained a moderate 61%. Housing improved 18% in gold terms, and most recently, during the 2022-2024 inflation surge, housing corrected 12% in USD. Gold rose 24% as an inflation hedge. Housing in gold terms declined 29%. This pattern demonstrates how gold tends to outperform during periods of economic stress and high inflation, while real estate may perform better during periods of economic stability and low interest rates. Several structural factors have contributed to gold's outperformance against real estate. First, real estate requires ongoing expenses like property taxes, insurance, and repairs that erode real returns, while gold has minimal storage costs. Second, new housing is continually built, expanding supply, while gold mining adds only about 1.5% to existing supply annually. Third, housing crashes trigger central bank easing, which typically benefits gold more than real estate in the rebound. Fourth, gold can be sold globally in minutes, while real estate transactions take weeks or months and include significant transaction costs. Finally, gold typically performs exceptionally well during periods of economic stress and high inflation, serving as a flight-to-quality asset when real estate markets struggle. Let's look at the numbers. Gold has delivered a 9.1% annualized return compared to real estate's 5.8% between 2002 and 2025, while gold's returns come with higher volatility, 18.7% versus 12.4%. Their Sharpe ratios, which measure risk-adjusted returns, are nearly identical at 0.49 and 0.47, respectively. This suggests that gold's higher returns adequately compensate for its additional volatility risk. The liquidity profile is drastically different as well. Real estate transactions typically take 45 and 90 days with costs of 5 to 8% of value, while gold can be traded instantly with transaction costs of just 0.5 to 2%. Despite gold's overall advantage, real estate has outperformed gold during specific periods. During the 1980-2000 period, when gold declined from its 1980 peak, during low interest rate environments with aggressive mortgage lending, in regions with strict zoning restrictions limiting new supply, in emerging economies during rapid industrialization phases, during economic recovery phases with strong employment growth. Remember, choosing between real estate and gold isn't about one being universally superior. It's about aligning the asset with your financial goals and risk profile. An often overlooked dimension is how each asset functions as collateral for borrowing. Real estate typically offers higher loan-to-value ratios, 80-95% compared to gold, 75-80%. But gold loans process much faster, under 24 hours versus 45 to 90 days, with minimal documentation. During the 2020-2023 inflation surge, gold loan volumes increased 142%, while mortgage approvals dropped 33% as rates spiked. Gold loans remain accessible during market crashes when real estate lending often freezes. The 2022 Russian invasion of Ukraine provides a fascinating case study of how both assets perform during extreme crisis. The data reveals a stark contrast. Properties in the eastern conflict zone lost 80-90% of their value and became entirely illiquid, while properties in western safe havens, like Lviv, saw prices increase by 47% with near-perfect occupancy rates. Meanwhile, gold maintained its global value and liquidity regardless of location. Ukrainian refugees who held gold could easily transport wealth across borders and exchange it at consistent global rates. Gold's portability and universal recognition proved decisive advantages in crisis conditions. The historical relationship between these assets suggests several strategies for wealth preservation. Consider rebalancing between real estate and gold based on their relative valuation. Homes priced in gold ounces. When housing costs more than 350 gold ounces, historical data suggests gold may be the better value. When housing costs less than 150 gold ounces, real estate may offer superior value. The optimal 2025 allocation framework varies by geopolitical risk. In stable regions, 60% real estate, 20% gold, 20% cash. In high-risk regions, 20% real estate, 50% gold, 30% foreign assets. In active conflict zones, 0% real estate, 80% gold, 20% cryptocurrency. Conclusion. As of October 2024, the median U.S. home price stands at approximately 157.2 ounces of gold, well below the historical peak of 677.1 ounces seen in 2002. Both assets offer distinct advantages. Gold provides superior returns, better inflation protection, and unmatched crisis liquidity. Real estate offers rental income, higher loan-to-value ratios, lower volatility, and utility value through occupancy. The Ukraine crisis revealed a critical insight. Real estate's geographic immobility becomes a severe liability during geopolitical turmoil, while gold's portability and universal recognition prove decisive advantages. For investors seeking to preserve wealth across generations, understanding both the gold-to-real estate ratio and geopolitical risk factors provides a powerful framework that transcends the illusions created by fiat currency debasement. Which asset is right for you? That depends on your personal goals, timeline, and risk tolerance. But now you have the data to make an informed decision beyond the monetary illusions we often take for granted. Thanks for watching. If you found this analysis valuable, please like, subscribe, and share with someone who's debating their next investment move.